Let me tell you something that I've learned in 15 years of sitting across the table from retirees. The hardest part of retirement isn't figuring out how much you've saved or when to take CPP or OAS. It's when you think you've got everything lined up. You've got a budget, you've got your accounts, and then out of nowhere, taxes show up and completely blindside you. Now, I've had people look me in the eye and say, Adam, I thought I was doing everything right. Why am I paying more taxes now than when I was working? And then it clicks. Retirement isn't just about drawing money from savings. It's about dodging the hidden tax traps that most people never even see until it's too late. And today we're going to walk you through the biggest tax traps hiding in your retirement income here in Canada. And just as important as the numbers, I'm going to talk about the psychology behind these traps, because these aren't just line items on a tax return. They cause stress, they create fear, and sometimes they stop people from enjoying the retirement that they've worked so hard for their entire lives. All right, let's start with the big one, the Old Age Security Recovery Tax, and it's also known as the OAS clawback. Now, most Canadians know about OAS. It's one of the cornerstones of retirement income here in this country. You turn 65, you qualify, and you start receiving a monthly payment. But here's what fewer people actually realize. The government can start clawing it back once your net income goes above a certain threshold. So in 2025, that line in the sand is around $93,454. So if you go over that, for every extra dollar that you earn, you're going to lose 15 cents of OAS. Now, that doesn't sound like much when you first hear it, 15 cents. But here's the trap. If you're not paying attention, that clawback stacks on top of your regular marginal tax rate. So 15 cents per dollar is actually 15%. So if you're paying 30 or 40% in tax, in reality, it could be closer to 50% or more on every extra dollar. Let's pause on the psychology here. So imagine that you've worked for decades, you've been careful, you've saved diligently, you're really proud of the nest egg that you've built. And then in retirement, the government says, well, you've done well. We're going to, unfortunately, take some of this benefit back. Now, it feels a bit like a punishment for being responsible with your money, right? And that's what really frustrates people. Now, I've had clients look at me and say, Adam, why did I bother saving? If I had just spent more, maybe I wouldn't really be in this mess. But here's the good news. There are strategies out there. You can shift income sources. So for example, if you have a TFSA, you can draw that down instead of pushing up your taxable income. You can spread income between spouses. You can even plan for withdrawals earlier, maybe in your 60s before OAS kicks in, so that you can use up maybe some of those taxable accounts when your income is lower. Now, the key is this. The clawback isn't a surprise tax if you plan ahead, but for many retirees, it feels like the rug has been pulled out from under them. Now, let's move on to another trap that catches almost everyone off guard, and that's RRIF minimums. Now, by the end of the year you turn 71, your RRSP has to be converted to a RRIF. And at that point, you're forced to take out a minimum amount every year, whether you need it or not. Now, for a lot of people, that's where the trap really springs shut, because once you're forced to withdraw, all of that money is taxable. Now, you might not need $30,000 or $40,000 of income every single year, but the government says, sorry, you're taking it anyway. And then suddenly you're going to be bumped into a higher tax bracket. Maybe your OAS starts getting clawed back and you feel like you've lost control over your own money. Now, psychologically, this one stings because retirement is supposed to be about freedom, right? You should feel that you're finally in control of your time and your money. But when the government forces your hand, it feels restrictive. And the anxiety isn't just about this year's taxes, it's the fear of, is this what happens now? How much worse is this going to get 10 years when maybe the withdrawals are going to get even bigger? Now, here's what I tell a lot of people. The RRIF trap is avoidable if you take the wheel early. Now, you might want to consider converting some of your RSPs to a RRIF in your 60s, even if you don't have to. Maybe you want to consider partial withdrawals that we call generally an RSP meltdown strategy, so that you're not forced into these huge withdrawals later on. You could also look at blending in income from non-registered accounts or TFSAs to keep your taxable income balanced. Now, I always say you can either decide when to pay tax or you can let the government decide for you. And I can promise you this, their timing won't be as friendly as yours. Next up is capital gains. Now, capital gains are actually a nice problem to have. This means that your investments have grown, right? But here's the trap. Triggering those gains at the wrong time can create a tax snowball. So let's say you sell a rental property or a cottage that you've held for decades. The gain could cost you hundreds of thousands of dollars. Now, half of that is taxable, and it also gets added on top of your regular income for the year. So this means that you could blow right past multiple tax brackets, your OAS gets clawed back, and other credits and benefits can disappear. And it's not just about big sales. Even something as simple as rebalancing a non-registered portfolio can trigger a gain that you weren't expecting. But again, let's pause on the human side because this isn't just about math. For a lot of people, selling a property or an investment has an emotional layer. That cottage that you've had for 30 years, well, it's full of memories. Selling isn't just a financial decision, it's a personal one. And when the tax bill arrives, the grief of losing that piece of history plus the shock of the tax hit can be overwhelming. That's why planning is key. You might be able to time your sales across multiple years, spread out that tax hit. You might consider tax gain or loss harvesting every year. You could use a TFSA strategically to shelter some growth. You can consider charitable donations strategically that use appreciated securities to offset tax. Now, capital gains aren't avoidable forever, but they are manageable if you don't let them sneak up on you first. Let's shift gears and talk about a trap that hits retirees at the lower income end, and that's the Guaranteed Income Supplement, or the GIS. Now, GIS is supposed to support low-income seniors, but here's how the trap actually works. Once your other income, that's excluding OAS, rises, your GIS benefit is reduced by 50 cents for every dollar you earn. Now, there's a bit of a nuance here. The first $5,000 of employment or self-employment income is typically exempt and doesn't reduce your GIS. But after that, income beyond the $5,000 starts to trigger the 50% clawback. Also, not all income types are treated equally in the GIS formula. Some are excluded and some are partially included. Now, importantly, OAS income is excluded when calculating the GIS clawback. Because of this structure, the financial impact can be really large, and that's where the psychological impact comes in. Now, many retirees hesitate to pick up part-time work or make withdrawals from their savings out of fear that even the most modest extra income will whittle down their GIS at a 50 cent on the dollar rate. Now, it can trap people into thinking that they have no room to earn more. Now, the good news is that there are strategies to mitigate this. Things like using your TFSA wherever possible, because TFSA withdrawals don't count as other income, so they don't trigger the clawback. Also, being mindful of timing the amounts of RSP and RRIF withdrawals, especially in years when GIS eligibility is critical. Now, if you're married or in a common law relationship, income splitting may shift income to the spouse with a lower income and reduce the total clawback. Finally, be strategic about how much additional income you allow yourself, balancing the gain with the GIS reduction. Now, for GIS recipients, the trap isn't just financial. It's the fear of doing the wrong thing and losing out. And that's the fear that often freezes people. And this is going to help you thaw that out. Finally, let's talk about withholding tax. When you take money out of your RSP or your RRIF, your financial institution is going to withhold a percentage as tax, depending on how much you actually withdraw. Now, most people assume that's the full bill, but it's not. It's just a down payment. Now, on a withdrawal less than $5,000, you're going to have to pay 10% as your withholding tax. Now, on withdrawals between $5,000 and $15,000, a 20% withdrawal or withheld amount will apply. Over $15,000, 30% is going to be withheld. Now, if you withdraw, say, $20,000, maybe that withholding tax is around $6,000. But when you file your tax return, your actual liability might be $7,000 or $8,000. And then suddenly you owe thousands more at tax time. Now, this one hits people hard emotionally because it feels like a bit of a betrayal. People say, why didn't anyone tell me this? Or I thought I had already paid the tax on it. And the stress that comes from an unexpected tax bill is real. It can make people pull back on spending, cancel trips, or even disrupt the whole system. Now, the solution is simple. Know your marginal tax rate. Treat the withholding as a prepayment. So run the numbers ahead of time so that there's no surprises later down the road. So those are the 5 big traps: OAS clawback, RRIF minimums, capital gains, GIS clawbacks, and withholding tax surprises. Now, here's the bigger picture. Retirement income planning is less about chasing returns and more about avoiding unnecessary taxes. It's about peace of mind. Now, I'll be honest with you. The financial side and psychological side are deeply connected. If you're constantly being blindsided by taxes, it's not just your wallet that suffers, it's your sense of security. And retirement should feel secure. So if you've been listening to this and you're thinking, wow, I might be walking into one of these traps myself, just know that you shouldn't stress about it because you're not alone. Now, most Canadians don't see these things coming until it's too late. But the good news is that you can plan your way around them. And if you need a little bit of help along the way, you can visit me anytime at stonecitywealth.com. I'm Adam, and I'll see you in the next video.